Good morning, everyone, and thanks for joining us for the October version of the Ag Economic Dialogue session. We have a great lineup of presenters and topics for you this morning. So without further ado, I think I will turn it over to Matthew Elliot, and he will give us a look at the current grain situation and some post-harvest marketing options that we can be considering. So with that, Matt, the floor is yours.
All right, thank you, Heather. Yes, my name's Matthew Elliot. I'm an associate professor in the Ness School of Management and Economics here at South Dakota State. I'm the agribusiness specialist for Extension. So today I was going to talk a little bit about the grain markets. I want to save enough time for Joe Santos, who's going to come follow me after to talk about macroeconomy. So I'll kind of run through some of this fairly quickly. We have quite a few different charts and data that we do track on our grain report, SDSU grain report, that's online. If you go to https://agland.sdstate.edu/grain, you can see those different graphs and charts, and you keep up to date on different data that we do track to follow what's going on in the grain markets from a fundamental perspective. So just kind of an overview of what I was going to cover today, just kind of looking at the current grain market outlook, specifically for corn and soybeans. Talk a little bit about Ukraine, since that's the major news item for this year in the commodity markets and grain markets, and the conflict continues. So we'll touch on that a little bit. I will touch a little bit on the low water levels on the Mississippi, and that's causing some basis impacts that we've seen so far and what that might mean for exports. Also just touch a little bit on the soybean export potential for this fall and into winter for the US, and what's going on in China with some of their soybean meal prices and hog prices, and then discuss the fertilizer impacts and potential 2023 input costs. So first, we'll just start with corn. So USDA had their report here just a couple weeks ago in October, and then their initial yield report there in September around the 11th or 12th. And kind of the surprise in the market was that the yields were much lower than perhaps what we expected at the initial part of this season. So right now, USDA is projecting corn yield to be about 171.9 bushels per acre. That's quite a bit down from last year's 177. And so that's kind of had a bullish effect on the market on top of all the other bullish items that have been going on with the Ukrainian conflict and so forth. If we look at U.S. corn demand and what USDA is looking forward for projected demand here in the next marketing year into 2023, ethanol right now they're projecting a slightly lower, partly related to macroeconomic concerns and lower gasoline demand, so there won't be as much ethanol blended into the gasoline chain, and that would cause less demand for ethanol or corn for use for ethanol. On the flip side, we've seen pretty good demand and high prices for cattle. We're especially on the export side for beef. Right now, U.S. beef exports is at a 7-year high. And so that's kind of a bullish aspect, and USDA is reflecting a little bit of that in their increased feed and residual use on corn going into 2023. Overall, the corn markets got pretty robust demand. Exports have stayed steady with the Ukrainian conflict, even though we have high prices. And as a result, ending stocks are relatively tight. So right now they're projecting at 1.17 billion bushels of ending stocks in 2023, which is pretty tight given our use levels, and that's keeping us fundamental support in the market on prices. So this is a chart that you can find on that website that we put together. It just looks at the ending stocks to use on the x-axis, and then the average monthly price for corn, for example, in this case, on the y-axis. And usually you see this inverse relationship. So as stocks to use as a percentage, ending stocks to use as a percentage for corn goes up, prices tend to fall, and vice versa. So right now we're in this red area here, about 8.3% stocks, ending stocks to use percentage. And that would imply something around a $6.30 price of corn if you take this linear line and kind of extrapolate from the observed stocks to use previously. And so we're probably a little bit higher right now with the average corn price at 685 in October. And that probably reflects a little bit of the uncertainty with Ukraine and additional demand concerns regarding Ukraine conflict. Also with the Ukraine, I mean, Ukraine's a primary exporter of corn to China. They're a primary export of wheat to Middle East, and then they also export sunflower oil. Exports out of Ukraine have significantly been reduced since the conflict and the Russian blockade. You know, there are some exports that are getting out of Ukraine. One, because the UN negotiated a humanitarian corridor over the summer, and they also some grain coming into Romania over land and on rail that's coming out of Ukraine. But for the most part, exports have been fairly reduced. So Ukraine, again, is a major exporter of corn, and especially in the fall. They right now, you know, in October, I think they estimated that they exported about 2 million metric tons, which is more than they did here in August and July and so forth, but it's a lot less than what they typically would at this point in the year, when they would be really ramping up their exports during the fall right after their harvest, about 4 to 5 million metric tons. So there's about 3 to 4 million metric tons basically missing from the world export market because of the Ukrainian conflict. U.S. corn exports have pretty much stayed at trendline levels, though we have are a little bit lower here in the fall for a couple of reasons. Number one, tight stocks, but also the low water levels. The Mississippi River is causing problems getting corn down on barges down to the Gulf export terminals, and so that's causing us to be a little bit lower on exports so far this year. China has also been one of the major demand points for exports for corn, and so far they haven't really entered the market as much as they typically have, and so U.S. corn exports to China has decreased about 21.5% from August to September compared to normal. So as I mentioned, Ukraine has kind of fallen off the world corn export market. Brazil and Argentina have really picked up kind of the slack. Both of them accounted for about 70% of corn exports in the world in September. U.S. is slightly lower in September for world corn exports at 17.1% versus 25%. So if we look at what kind of the market's thinking regarding the fundamental situation, you typically look at some of the monthly spread differences. And so this is a chart showing the spread difference between December corn and March corn of 23. So when you have an inverse relationship or a positive spread between December and March, that indicates a very bullish situation. Conversely, if you have a negative spread or a carry in the market, that kind of indicates that the market or people in the market that demand corn would be a little bit more comfortable with the situation. And right after the Russia invaded Ukraine, we saw this big spike in the spread to about 9 cents, plus 9 cents inverse level over the summer. And since that the invasion began, the market's been a little bit more comfortable with the corn flow, even with the Ukrainian conflict. And so that spread has come down now to there's a little bit of a carry in the market right now at minus 6 cents. So here's just some technical analysis of the corn price, December corn futures price right now. We obviously have some resistance at the $7 mark. We have support probably roughly around the 660 mark. And using the commodity channel index, which is indicated in this green line below here, corn right now, according to that index, would be about 6 cents overpriced at that 680 level. So one issue that's kind of cropped up here recently is the low water levels in the Mississippi River. And that's causing, barge rates to increase dramatically and basically caused barge traffic to cease, in the last couple of weeks. And this is typically when we'd see really ramping up grain exports down the Mississippi and Ohio rivers in order to get to the Gulf export markets. And so this is having a really historical effect. Roughly barge rates are about $2.5 to $3 a bushel right now, when they're typically only about 50 cents to $1 a bushel for barge rates. Well, we got some chat feedback coming here. If your mic's on, check to make sure it's muted. So we've seen some interesting basis impacts because of the low water levels on the Mississippi. Gulf basis for corn has been increasing, and for soybeans as well. And I'll show a chart on that. Right now, Gulf basis is $1.98 when it's typically about $1 over CBOT prices. Soybean or corn basis in East Central District of South Dakota is relatively strong, but it's been running relatively strong here, and it really hasn't been affected by the low water levels yet. So we're looking at about minus 13 cents right now in East Central District for corn basis on average. So the low water levels are not only going to impact the flow of grains down the river, but it could impact nitrogen and fertilizer prices coming up the river that going into spring, and then also chemicals and different things for inputs for the spring. This is the New Orleans urea price free on board. Fertilizer prices have been really high recently, especially after the conflict with Ukraine and Russia started. Fertilizer prices increased dramatically in the growing season and during the summer, but that have somewhat subsided since that early spring period. But we're still above last year levels, and we're still at a relatively high level for fertilizer prices, and especially as we look forward into next season. So as we look forward, corn market drivers that you need to pay attention to are, basically Brazil corn production. Brazil's expected to expand production, and what the yields are and what the area is going to be a big determinant in corn prices in the near term. Also, the Ukrainian conflict, how that continues to evolve, whether the humanitarian corridor is negotiated and extended, or if there tends to be, some kind of more of a blockade of grain exports out of Ukraine. So what little that is getting out, it would be reduced even further. Also, we just need to see verification of the lower yields in the U.S. If yields tend to be a little bit better, that would be obviously a bearish note. I tend to think that most people think the yields are pretty low. USDA is projecting and might not be as low as what they're projecting right now. The low water levels, if that continues into the winter and spring, that's going to really impact the corn market in different ways. Number one, with grain exports, but also with fertilizer prices as we look for plantings next season. That could reduce corn acreage going into 2023 because fertilizer prices might be too high of a level, and soybeans might be a better option to plant if that's the case. So now I'm going to turn just to soybeans real quick. Again, just like corn, we've seen the soybean yield lower this year compared to the last couple years. So right now, USDA is projecting about a 49.8 bushel per acre crop. That's down from the 51.4 we saw last year. So that was kind of a surprise to the market. U.S. soybean demand is pretty robust. Right now, USDA is projecting that crush is would increase from that 2.2 billion bushels to 2.23 billion bushels next year. So that's, kind of reflects that increased crush capacity that's been built in or invested in the U.S. over the past couple of years coming online. So it'll be interesting to see if we actually don't even beat those estimates on crush next year, just because we have excess crush capacity and excess demand right now for crushed soybeans. As for the export market, don't see really any changes in the robust demand for soybean exports. As a result, there's little left over for ending stocks. Basically, all soybeans that we're expected to produce this year are going to be crushed or exported, and that only leaves a bare minimum in the supply chain of about 200 million bushels per acre, or 200 million bushels, excuse me, according to USDA. And so ending stocks is relatively tight compared to normal in soybeans. Soybean export demand, like I said, we have been about normal, but because of these low river conditions, typically we'd see most of our soybeans flow down the river that would be exported in the market at this point in time of the year. And that's causing a real problem for us to meet this ramped up soybean export program that we typically do in October and November and going into December and January. And so if we can't move those soybeans down the river, they got to go by rail, and that's going to cause a delay in those shipments, and it could even further reduce or cause a reduction in our total exports that we're projecting for this year if they're not moved quickly enough. As we look at soybean stocks to use at the 200 million bushels for ending stocks, that roughly is about 4.5% stocks to use ratio. And much like in the corn and market, we see that that's relatively pretty tight. Unlike the corn market, though, that's probably right in line with what we would expect. Our current prices are about $13.78 in October, and with that 4.5% stocks to use, that's what we would expect is about a $13.80, $14 soybean price, given that certain stocks to use ratio. Soybean prices from a technical aspect, again, there's some resistance on corn or soybean prices above that $14 mark. We typically see some support level around $13.50. Volatility has been relatively low, and according to the commodity channel index, right now the price about $13.80 is about 10 cents above what a fair price or what the expected price would be for soybeans right now. As we look at world soybean prices, especially the U.S. soybean price compared to Brazil, we're very we're very competitive right now, which we typically are. That's why we export more during this period of the year. So right now we're about $2 per bushel lower for soybean prices compared to Brazil. And so that's, if we could export them, if we could get the soybeans down the river or to the export terminals, they would go rather quickly. It's just getting them from the interior to the export terminals that's the problem. Part of the robust demand right now is because Chinese soybean meal is skyrocketing. So China typically imports most of those U.S. soybeans right now and crushes it for soybean meal to feed their large hog population. And as a result of these delayed exports from the U.S., we've seen soybean meal prices really increase about 30% here in the last 15 weeks in China. And also hog prices have been increasing relatively a lot. Here in the last 30 weeks, we've seen about 127% increase in hog prices in China. And so there's a lot of price pressure from China for soybeans and a robust demand in that direction. As for basis for South Dakota in soybeans, our basis right now in the East Central District is about minus 37 cents, which is about normal range for us. This is compared to the Gulf basis for soybean right now is about $3.32 over the CBOT futures price, which is about three times higher than normal. That's just because we have this robust export demand at the terminal level, but we can't get those into your soybeans down to the export terminals because of the low water levels that I mentioned before. So as we look forward, to the 2023 growing season and the marketing year, obviously the South America production, so Argentina and Brazil are going to be major factors in, the soybean prices. If they don't have good yields or their area is not as large as expected, we could see pressure, or we could see more bullish prices. And then conversely, if they have bigger production, that could ultimately pressure prices. Like corn, we need to see verification of those lower yields in the United States. We do have a fairly, written lowdown yield prospects right now. So, I think maybe the market kind of tends to think those USDA yield numbers are a little bit on the low side. And so if we see higher yields, that could ultimately pressure prices just a little bit. This low water on the Mississippi River is a major problem for soybeans right now, as we're supposed to be ramping up our soybean exports. So that could really impact our overall soybean export demand and cause us to have higher ending stocks in the future that would have pressure on the soybean prices going into next year. Again, the fertilizer prices could cause more corn acres to be shifted to soybeans because producers trying to avoid that higher fertilizer price. So it'll be interesting to see what fertilizer prices do and how that might shift acre competition going into next season. But with that, that's what I have for right now. I could take, with the remaining 5 minutes or so, I could take some questions or take comments if there are any.
Okay, so we'll open the floor. If anyone has a question, you can either type them into the chat box or unmute your microphone and ask them at this time. Otherwise, we will stop the recording at the end of the session and have a question and answer session. But I know Dr. Elliot needs to run to another meeting at 11. So if you have those questions related to marketing and they don't come to you while he's available, put them into the chat or send me an email and I will get them sent out to him and he can respond directly to you. Right now, Matt, I do not have anyone actively typing or unmuting. So I think with that, we'll turn it over to Dr. Santos and he can begin sharing his screen and we will go from there.
Will do. Thank you.
Thank you. I appreciate your time.
Thanks, Matt. All right. How are we on that, Heather?
Looks great. Thank you.
Okay, and everyone can hear me?
Yes.
Okay. All right, we'll get going. So thank you everyone for inviting me to participate, and Heather particularly for inviting me. So I'm Joe Santos. I'm here at the Ness School of Management and Economics. I'm a colleague of Matthew Elliott's, and I currently direct the school. And as I understand, my mission today is going to be talking about the inflationary environment that we find ourselves in and the monetary policy responses to that environment and what the sort of knock-on effects of those responses are likely to be. So I'm going to invite everybody to participate actively if they wish. I know it feels a little weird sometimes to unmute yourself and just start asking a question, but just overcome that that tendency to not want to do that and just start talking, and I will stop and we can make this really interactive. So I've built this around what I think of as takeaways. So 5 takeaways, and I begin, as the title suggests, with a takeaway around money and the supply of money in the economy. And so the first takeaway, is that inflation is a monetary, not a supply chain phenomenon. And you'll see what I mean by this in just a moment. But what I'm getting at is that although there are clearly supply chain problems in the economy, at the end of the day, it really is a matter of too much money chasing too few goods. That is, inflation is really a matter of that. And so at the end of the day, the problem here for policymakers is really one of dealing with the money supply. So I want to demonstrate this a little bit, and it's going to seem a little analytical for like 2 slides, but just bear with me for a moment. The way we think about the role of money in the economy, very simply, is something we call a quantity equation. And it's really straightforward. It basically says that the amount of money in the economy, M, times the amount of times it changes hands, that's velocity, is equal to the amount of income in the economy. So in other words, you can think of this as money flow, like $10 changing hands 2 times a year is $20. And you can find that $20 on the other side of the equation in the form of $20 of stuff that was purchased as a result of that money, right? So this is something economists really arm themselves with a lot when they think about the monetary effects of on an economy. And so I want to just show you some data and just show you how reliable this relationship is, and then show you why I think ultimately what we're dealing with right now is a monetary phenomenon. So here, what I've done very simply is just taken a look at some data, and I've looked at quarterly data of the money supply of this sort of odd thing we call velocity, the average number of times we exchange money between each other, the price level, and then output. And what I want you to do is just like focus on a row. So there I am, I focused on 1980 to 1999. It's a 20-year period. And so what you're looking at, you can imagine, is just like from an Excel spreadsheet. I just averaged the growth of the money supply during those 20 years. That's 1.4%. I averaged the growth of like inflation over those 20 years. That's like 0.8% a quarter, and so on. And what you notice is when you look across the row, MV equals PY, right? The growth in the money supply and the growth in velocity equals the growth in the price level and the growth of output. So this is a really reliable relationship between the money supply and all the other important variables in the economy. And I'll show you now why I want to emphasize this. Going back, say or going forward to the current period, you'll see here the money supply growth is actually quite large. It's 2.3% every quarter, more money in the economy flowing into the economy. And then if you go all the way over to the price level, you'll notice it too is quite high, 1.7% every quarter. So if you want an annual sense of that, multiply these numbers times 4, you start to see just how significant both the growth in the money supply and the growth of the inflation is. So MV equals PY, and at the moment, the growth in M is actually quite robust. And sure enough, the growth in P is actually quite robust as well. So what macroeconomists usually take from this is just what I just sort of said, is that really fundamentally money drives prices. And so if we go back to that exact same table, no new data, you'll see this relationship if you just sort of glance at the table a little bit differently. So this time, instead of looking across from left to right and finding a particular row, look up and down. And you'll notice this in those periods, say 20-year periods or the entire time period, 60 to 2019 or whatever, when the M number was relatively large in that table, the corresponding P number was also relatively large in that table. So this is, when macroeconomists are asked what's the cause of inflation, while we understand the supply chain crises and how those cause initial sort of shocks to prices, ultimately, if we're living with inflation for a long time, we reason it's because there's too much money in the economy. And again, as this table indicates, pick a year, a period, say 1.4% for money growth. You don't get much inflation on that 0.8 side. 2.3% for money growth, like now, you do get a lot of inflation, 1.7, and so on. And if you take every quarter of money growth and output growth in the US economy, you'll see this. So this is a really crazy picture, but every one of those dots is a quarter in the life of the economy. And so, for example, if you pick like 4% money growth, go up, turn left, pick a dot, you get a certain level of inflation. And what you notice is the larger the growth in the money supply, think left to right along the horizontal axis, the higher the inflation, think down to up on the vertical axis. So there's a really compelling positive relationship between money growth and inflation, right? And so sure enough, what we're observing right now is not just high growth in the money supply, but we're also, so there it is, enormous growth in the money stock. So by the way, what is this when we say money? This is, as I like to tell my students, everything you can go to Jimmy John's with and buy lunch, right? So this is currency in the hands of the public. It's paper, it's coin, it's checking account balances, those liquid assets, as we view them as assets that we can exchange for goods and services very easily, right? And so the growth in the money stock during the pandemic was phenomenally high. I just encourage folks to look at that peak that I know you're all looking at right now, but then compare it to the very left side where you also see some peaks, but not nearly as high. Those peaks on the left, that's the so-called great inflation of the 1970s. So one way to put this picture in a sentence would be to say, for a while, not for a very long while, but for a while during the pandemic and shortly thereafter, the growth in the money supply exceeded by a factor of like 2 the growth in the money supply during the great inflation of the 1970s. So it's not entirely surprising if you buy that whole story I just told you about the quantity equation, that because we have all that money growth in the system, that we now also have a lot of inflation in the system, right? And so taking a look at that, there it is. That's just one measure of the inflation rate. But if anyone in the audience has been living under a rock and you don't know that we have inflation right now, this picture, I think, clearly demonstrates it. And so this is the Fed's preferred measure of inflation. And it's not the CPI, but it's one that they use, a so-called consumer expenditures index. And according to that, it doesn't matter what the number is, it's a lot higher than it was, right? If we break that down, I don't want to deny that there has been a supply chain consequence to the rate of inflation, but I'm just trying to emphasize that now what we're dealing with is something more general that's largely independent of the supply chain crisis. Let me just to emphasize that a little bit. I'm just going to deconstruct this a little bit. So these are consumer inflation rates, right? So there's the CPI in blue. Right. But then there's also durable goods prices, non-durable goods prices, and services prices. And all I want to emphasize here is that I don't want to deny that there was a supply chain crisis and that the supply chain crisis had consequences for prices in general. So, for example, if we think about the stuff we could not get during the pandemic, the couch or the Peloton bike that we no longer want to use, or whatever the case may be, those are durable goods. And sure enough, those durable goods prices rose dramatically during the pandemic. But you'll notice they've come down to what is still an uncomfortably high rate of inflation, but one that looks a lot like the inflation rates we have from the other kinds of goods and services in this picture. So durable goods prices jumped dramatically. Even non-durable goods, groceries and so forth, rose rather significantly. And then services really didn't have much of an effect because during the pandemic, the last thing any of us thought of doing was engaging in social, interactions in ways like in restaurants and hotels and the rest. So those prices didn't experience the same pressure. But the point of the picture, I think my point, is the very right side. All of these have now converged to an uncomfortably high number, not as high as, say, durable goods prices were, but nevertheless uncomfortably high. And the reason this is important is because to a macroeconomist, that's an inflation. And inflation is a fall in the purchasing power of money, independently of what the money is being used to purchase. And so now it doesn't matter if you're trying to buy that couch or a latte or a haircut, you need more money to buy any of those things. So now we are really living in a general inflation. And to a macroeconomist like myself, we tend to think of that as really caused by too much money, right? And that, of course, is an instrument of the central bank. And so this is why now our attention has turned so uniformly to the Federal Reserve, right? The last bit about this is just a point, how long is this going to last? This is really just a practical matter. It's almost a matter of arithmetic. But the way the Consumer Price Index is calculated, it includes rents. It includes essentially home prices through the home services provided by those homes. So it doesn't so much include the price of a home bought 10 years ago, but it includes the housing services the home provides. And that is marked to rental prices. And so rents are often lagged because they're contracted, for years at a time. So rent prices tend to be staggered. They're what we call sticky or rigid. They don't rise immediately because someone's locked into a contract. And so all I want to emphasize here is that housing is a big piece of the Consumer Price Index because it's a big piece of housing in general, household expenditures in general, and rents have more to go in terms of rising. And so just arithmetically, the CPI is going to be sort of sticky at a high level, in part because rental prices are going to continue to rise as essentially the owners of those properties gain the opportunity to renegotiate, that would likely be higher rents, right? So that's just sort of a mechanical sidebar, if you will, but the CPI is going to have trouble recovering. That is coming back to something like 2% growth a year, in part because the CPI is just arithmetically constructed in such a way that it includes rents. Rents matter, and rents tend to be backward representing, right? If not backward looking, they reflect leases signed in the past. The last thing I'll just say is that no matter how you measure inflation now, all items, the core, median, trim off, outliers, whatever, you now see, again, we have just a uniformity in terms of price pressure. And I'll just emphasize one, the core. This is what's really riling everyone, is that you exclude food and energy, you get rid of those volatile categories, and you still see this upward pressure in ways that are really disconcerting to monetary policymakers. Okay, so the second takeaway, right? So the first is it's a monetary problem at the end of the day. The second is that real interest rates remain too low. So when we talk about a real interest rate, what we mean is the purchasing power of that interest rate, if you will. So if I borrow $100 from you and you say the real interest rate is 3%, what you mean to say is the actual interest rate may be something very different, but in terms of purchasing power, I'm returning to you 3% of the purchasing power you lent me. So the easiest way to think about real rates is not in terms of money, but I like to think of it in terms of coconuts. So if you lend me 100 coconuts, I owe you 3 coconuts in addition to the 100 that you gave me. That's the real rate. I'm going to give you back 3 units of what you gave me, right? Nominal interest rates are what we focus on. That's just the stated rate. So maybe you say the nominal interest rate is 6%, but that doesn't really mean much to me as a borrower, because again, there's the possibility that through inflation, what I pay you back is going to be far less in terms of purchasing power, right? So real rates adjust for that inflationary decay. And so I borrowed 100 coconuts from you, and I owe you 8%. That would mean 8 coconuts. If the real rate went down to 2 because of inflation, now I owe you 2, right? So the burden of borrowing money and paying it back is a lot less when inflation is high. And so the real rate adjusts for that. And so I was going to show you this real rate to give you a sense of this. So first off, just interest rates in general. Again, unless you're living under a rock, you probably know interest rates are rising. So here I just picked 2 just to level the base here. So the Fed funds rate is rising, the 10-year Treasury yield is rising, and these are monthly rates. So it's an average. It's not up to the minute. The current 10-month is 10 years higher than that. So they're rising, and so is the yield curve inverting, because the 2-year Treasury, for example, is even higher than the 10-year. And so here you see a negative yield curve. That is, the gap between the 10 and the 2 is actually negative right now. So all of this is sort of what the market's looking at, saying, oh gosh, look at all of this pressure on rates. Short-term rates are rising, long-term rates are rising, short-term rates are rising really aggressively. So the yield curve is negative, and so on. And the point of this takeaway is, though all of that is true, it is still also true that real interest rates, the number of coconuts I have to return to you, remain very, very low, because inflation is outstripping these increases in interest rates. So let me show you some of these measures. These are kind of fun to look at. So this is not a measure that's on any loan contract, but it's what we get when we subtract inflation expectations from a nominal interest rate. So according to the 1 year, it's negative. So how do you get your mind around a negative interest rate? Well, go back to coconuts. When the real interest rate is negative, one way to think about that is you lend me 100 coconuts and say it's negative 3%, I give you back 97. So I actually give you back less, again, in terms of purchasing power, in terms of stuff, in terms of coconuts, I give you back fewer than you gave me. That's an incredibly stimulative lending environment, right? Because the borrowers really have every incentive to borrow. And so 1-year rates are negative. 10-year rates are mildly positive, but the point is none of these rates are high enough right now to really choke off borrowing, which is what you want to do if you're trying to deal with the inflation problem. You're trying to reduce demand, reduce spending, and borrowing fuel spending. Some other really crude ways to measure it, just to take the actual interest rate, like the 1 year, and just subtract the actual CPI inflation rate. So I just did that. It's very raw, but I did it for every data point in the picture. So what you can see here is, from 2015, and I could have gone back much farther than that, real interest rates by this very crude measure of taking the actual inflation rate, subtracting inflation, the actual interest rate, forgive me, and subtracting inflation, the crude rate, the difference between the two has never been this low. So these rates are shockingly negative right now. And again, if you're a central bank looking to raise rates, to reduce credit supply, to reduce spending, you have a long way to go. And I think the financial markets have largely deduced this. And this is why things have been so volatile and prices have been so weak in securities prices and so forth. Because I think everyone looking at these figures in real terms realizes rates are not high enough yet. This is perhaps the most interesting way to see this. If you take your eye and just look at the left and just slowly go to the right of this picture, for a long time, like for 2/3 of the distance, as you span left to right, it looks like you tied a blue crayon and a red crayon together and you drew the picture. And then all of a sudden around the pandemic, the blue crayon breaks from the red crayon. And what the blue line is the inflation rate. And what the red line is the 1-year treasury rate. And what you notice is while they used to move in tandem, now inflation has sort of surpassed, if you will, the treasury rate. And so, we say the Fed is behind the curve. I like to look at this picture and think, no, the Fed is actually under the curve, right? The interest rate, the red line, has lost the race with inflation. And by the way, if you think, if you put the blue line, you look at your thumb to index finger, the difference between the two, that's the negative real interest rate I was showing you earlier, right? That's a very upside down situation. That means credit is cheap. It's still cheap. And so there's a lot to go in terms of interest rate movement. All right, so the third takeaway is that monetary policy demand destruction is not over. So in other words, inflation is a monetary phenomenon. That's the first takeaway. Interest rates are not high enough. That's the second takeaway. And so interest rates need to go higher, which means more demand has to be destroyed than has been destroyed thus far. It's a really brutal kind of statement, but that's the term we use in macro of, demand destruction, right? So what do we mean by this? So let me just indulge me for a second and let's go to a demand and supply diagram. So let's just think about what's happened with the crisis and so on, right? So when the pandemic hit, we had this supply chain crisis. There's no denying that. And so we could think about, that happening, right? So we had this supply shock. And so as a result of the supply shock, we ended up with higher prices and we ended up with less output.
I was thinking we had quality today, but.
Oops.
Okay. Oh yeah, I'm donating blood today. That's what I'm doing.
Okay, Joe,
Okay,
so
I'm
I
back.
muted that and muted you. Okay, you're back.
I'm back.
Okay.
So we had the supply shock, we had inflation, we had this, remember this 10% drop in GDP, that's the left pointing arrow, right? Output fell dramatically. And so we had that. Right. So what did policymakers do? You remember the story, right? We stimulated demand. And we did so in particular with 3 instruments. We grew the money supply, we lowered interest rates, and we increased transfer payments, or what we all affectionately refer to as stimmies, right? Those were the stimulus checks. And so that stimulated demand. And if you look at this picture, what did it end up doing? Well, in terms of output, it got us back to where we were before. So if you look at the horizontal axis, you're back where you were. But of course, according to the vertical axis, now you've got more inflation than anybody would want, right? So this is where the central bank and everybody found themselves a few months ago. And so let me clean it up, right? And so what do you do now? Well, this is where the demand destruction comes in. As a central bank or as any macroeconomic policymaker knows, you can't control the red line. I mean, think about that for like 4 seconds, right? If you can control the red line, you would have controlled the red line by now. You would have fixed the supply chain, but you can't. And so what you do if inflation is really bothering you is you try to get it back to target. And so this is, how do you do it? Well, if you're a central bank, you lower the money supply, you raise interest rates, and, forgive the term, you destroy demand, right? And so that means you bring the blue line to the left. Of course, if you just do that in your mind's eye, you'll see the price fall, but you'll also see output fall. And this is sort of the old game. This is the trade-off that macro policymakers always face. And this is not new. This is a great clip from the 1970s. Paul Volcker was the chair of the Fed then, and he had this great line. Well, it wasn't really great. It was horribly depressing, but he, as the central banker, was quoted in the New York Times as saying, the standard of living of the average American has to decline. I don't think you can escape that. And what he was saying was, we're going to need to destroy demand because we're dealing with this inflation problem. And that's the only way we have to deal with it, is to basically shift aggregate demand to the left. So that's the situation we find ourselves in right now. And if you look at some of the data, you'll notice this demand destruction already. So let me go to a little bit of data. So for example, here's real disposable personal income, really straightforward picture. If you're above zero, it's growth. If you're below zero, it's not. And so what you notice is that real disposable personal income has been declining. This is on a monthly basis, right? So it's obvious that what's happened on the last third of that picture on the right is not good, right? What else? Different ways we can measure this. If we look at just GDP, it's pretty subtle when you compare it to the crazy gyrations during the pandemic, but nevertheless, there are two red bars there on the right. If you look closely, they're not very negative, but they're negative. And that means real GDP is contracting. If you think of that demand supply diagram, that's moving to the left along the y-axis, right? That's what it looks like in reality. Y is falling, and so you have this negative growth in GDP. And then the other way to see it is, this is a sort of favorite of mine, is not so much to look at output growth, but to look at where output is relative to where we imagine it could be if everything were right with the world, what we call potential output. And the difference between potential output and where we actually are is what we call the gap, for obvious reasons. And so as you could see, as we were going up to the pandemic, the economy was expanding and it was approaching its potential. And so those little blue bars kind of from left to right slowly disappear. And then we're at potential. Right before the pandemic hits, we're sort of running on all cylinders. And so there's really no visual gap. And then the pandemic hits and the gap gets incredibly negative, of course. And then we sort of come out of the pandemic. And of course, then this picture ends with two red bars. So, how do you use the red bars in a sentence? Well, if that last red bar, I don't know, I'll just say lines up with 1%, that means that the economy in that quarter, that's the second quarter of 2022, was performing at 2% below what we think its potential was. So we have a negative output gap now. Again, that's what demand destruction looks like, right? And the not so rosy scenario that I'm painting here is that if we think about all these takeaways, it's a monetary problem. Real interest rates are not high enough. They have to go higher. Well, that means more of this demand has to be destroyed. Having said all that, I don't think it's that 70s show. And here I'll just be very brief, but there are a couple of features of the current situation that I think are importantly different than the 70s, though there are similarities that are not very comforting. But number one is the inflation rate itself. So we had these large increases in the inflation rate, and the red line just sort of a smooth line to get rid of outlying behavior and noise and so on. And whether you look at the red or the blue, you notice the far right doesn't look like the twin peaks of the Great Inflation. I mean, there are similarities, it sort of rhymes with it, but it's not exactly the same thing yet. So that's, better news than than it could be if it looked identical to the 70s. The other thing is we're operating in an environment that's very different today. Now, this may seem like a bizarre picture to put up, right? Exchange rates, what does this have to do with anything? Well, during the 1970s, there was something else that was happening, and that was the world was transitioning from essentially a gold commodity-based exchange rate system where the dollar was indirectly linked to the value of a fixed commodity like gold to one where it floated freely. And the point of this is just that if you're a central bank in the 1970s, this is a very jarring change in global financial policy that can leave you, the central bank, in a kind of precarious position of not knowing exactly how to perform monetary policy now that your medium of exchange, your dollar, is no longer directly linked to a commodity. And so you don't have that anchor to value the purchasing power of the money anymore. And so that happened in the 1970s. And so my point here is just that while we're still in a flexible exchange rate world, we've been in that world now for decades, and the central bank has had plenty of time to sort of get used to that. But in the 70s, this also happened. And so that shock made performing monetary policy very challenging for the Fed. And there's a lot of history to suggest that they didn't know exactly how to respond to that. So that's, I guess, the good news is we've had many, many decades of experience now with this fiat money standard we now have. And the other point of this is the output gap. So during the 1970s, if you let your eye just glance over to right before that 1980 period, what you'll notice is that there are several periods in which the output gap is positive. Now that may sound great. It means the economy is performing beyond its potential, but that's very inflationary, right? You're pushing the economy. Think of like a boiler. The pressure in the economy is exceeding what the boiler can handle. And so during the 1970s, we had a positive output gap at least twice. And there's a lot of historical evidence to suggest that the central bank, the Fed, had no clue that this was the case. They thought the economy was much sicker than it really was. So the good news here is if you glance, you let your eye go all the way to the right of the picture, you'll notice the output gap, as I showed you before in a bar chart, is negative. So only to a macroeconomist is this good news to say the output gap's negative. We're underperforming. But the good news here is that at least we're not pushing the pressure in the boiler to exceed what the boiler can handle, right? Right now, unlike the 1970s, we don't reason that our economy is sort of over its capacity, whereas we know that that was the case in the 70s. So this is a sort of good news. We're not overdoing it in terms of production. This is the one that probably is the most troubling, and that I wish I could say we're different than the 70s, and we're not. And it goes back to that real interest rate problem. Real interest rates in the 70s, as you could see there, those twin peaks are now twin sort of troughs, because this is the real interest rate. You had negative real interest rates. Again, people were borrowing 100 coconuts and returning 97. And so that was a really accommodating credit environment. And sadly, if you go to the current period, same measure, same crude calculation. I do it for every data point that makes up the blue line. And now you've got this deep negative real interest rate again, right? So this is a similarity that's really disturbing, in that we have a kind of accommodating monetary environment that resembles the accommodating monetary environment of the 1970s. So that's not great. Finally, I just end it really quickly with one more takeaway, and that is that property markets are not immune to any of this. So here, I just want to emphasize there's been a lot of work in this field. There's been a recent article in our American Economic Journal, like just out. So I thought this was kind of interesting and timely. What these folks do, very briefly, is they look at the effect of monetary policy on house prices. And I want to emphasize this because I think we often think in the American sort of culture and obsession with housing that house prices can only go up. There's a lot of evidence, this happens to be their mapping based on their data, that when interest rates rise by 1%, this color corresponds to how much housing prices fall. And it's roughly about between 2 and 4%. And so the data is sort of, that's where they have the data. And so that's why we see those colors in those spots. This look like a random sampling of puzzle pieces. And South Dakota is represented in their study as well, as you can see. The point of this is just that based on their evidence, they see that when monetary policy tightens and interest rates rise, housing prices fall. And that's the picture you're looking at, is based on a 1% increase in interest rates. So if the Fed is trying to increase interest rates by 4%, and this relationship is linear, you would imagine house prices would fall by 4 times the amount that this picture depicts, right? So the point is, housing is not immune. And sure enough, we're seeing a little evidence of this. So whether we look at the Case-Shiller Home Price Index, where the last data point doesn't look like a lot of the previous data points, or we look at the supply of houses, here a big number is problematic. We see an increased supply of houses. There does seem to be some evidence of softening in real estate prices, and we would expect that. And again, I just end with that takeaway, because I think sometimes in our sort of cultural obsession with housing, we tend to think houses can never suffer declines in prices. And we know, of course, that's not true. So that's it. Inflation's a monetary, not a supply chain phenomenon. Real interest rates remain too low. Monetary policy demand destruction is not over. It's not the 70s, at least not yet. And then Fed policy is not immune. I just want to end with a quick shameless plug. If anyone's really interested in this stuff, the Ness School is hosting Neil Kashkari, who many of you know is the president of the Minneapolis Federal Reserve Bank. And Neil Kashkari will be here on November 9th. So jot that down if you're interested. And thanks again for the opportunity.
Thanks a bunch, Dr. Santos. We appreciate your time and your presentation.